You are terrible at investing, and honestly, that might be the best possible starting point for this video. Because here is the thing that nobody in the finance world wants to admit out loud. You do not need to be good at investing to build serious wealth. You do not need to read the Wall Street Journal every morning. You do not need to understand what a price-to-earnings ratio means, or care about quarterly earnings calls, or have any opinion whatsoever about Federal Reserve interest rate decisions. In fact, the less you tinker, the better you will probably do. And today, I am going to prove that to you, using one of the most powerful and most misunderstood financial tools that exists for regular people, the index fund. Stick with me because by the end of this video, you will understand exactly what an index fund is, why it has quietly made more ordinary people wealthy than almost any other investment strategy, how it compares to having a professional manage your money, and most importantly, the specific steps you can actually take starting today, even if you have never invested a single dollar in your life. Let us start with the thing that probably brought you here, which is that investing feels incredibly intimidating. And that feeling is completely understandable because for most of us, nobody ever sat down and explained any of this. School did not teach us. Our parents either did not know or were too scared to talk about money. And when we finally do try to learn, we get buried under jargon, contradictory opinions, and people on social media showing off their trading setups like they are running a NASA mission. It all feels like it was deliberately designed to keep normal people out. Here is what I want you to hold on to as you watch this. That feeling of exclusion was never really justified. The fundamental concept behind index fund investing is so simple that once someone explains it to you properly, you will probably feel a little frustrated that you did not know it sooner. So let me do that right now. An index is just a list. That is genuinely all it is. A curated list of things organized by some specific criteria. Think about how a music chart works. It takes all the songs being sold or streamed in a given period and ranks the most popular ones. That ranking is an index. Now imagine if instead of songs we are talking about companies, and instead of measuring streams, we are measuring the total value of each company based on how many shares exist multiplied by the current share price. That number is called market capitalization, and it gives you a snapshot of how large and valuable a company is. Take the 500 biggest public companies in the United States, rank them by market cap, and you have the S&P 500, which is probably the most famous financial index in the world. Now here is where it gets interesting. An index fund is a single investment product that allows you to own a tiny slice of every company on that list simultaneously. One purchase, and you are instantly a partial owner of hundreds of different businesses. When you buy into something tracking the S&P 500, you own a little bit of Apple, a little bit of Microsoft, a little bit of Amazon, a little bit of hundreds of others all at once. The biggest companies get a larger slice of your investment, and the smaller ones get less, but you are spread across all of them. Why does this matter so much? Because diversification is one of the most powerful risk management tools that exists. If you put all your money into one company, and that company has a terrible year, you could lose a devastating amount. But if you are spread across 500 companies, the ones doing badly are cushioned by the ones doing well. Some businesses will always have bad quarters. Some will even go bankrupt. But the overall market, the collective performance of hundreds of companies representing the backbone of an entire economy, has historically moved in one general direction over long enough time periods: upward. Here is a number that should genuinely grab your attention. Nobody who has bought and held a broad market index fund tracking the S&P 500 and kept it for 20 years or more has ever ended up losing money. That is not a guarantee about the future, and please do not take it as financial advice specific to your situation. But that historical record is remarkable, and it speaks to the long-term resilience of diversified market investing. Now let me introduce the concept that transforms index funds from just pretty good to genuinely extraordinary: compound growth. This is the part where your brain might initially resist believing the numbers. If you invest around $200 per month and achieve an average annual return of roughly 8%, in 45 years you would have accumulated over $1 million. $200 a month, not $2,000. Not 20,000, 200. That number seems almost impossible, but it is entirely a function of time and compounding. Each year your returns generate their own returns. Interest earns interest. Growth builds on growth. The snowball gets bigger the longer it rolls. The critical insight here is that time is not just helpful, it is the secret weapon. The person who starts at 25 and invests a modest amount consistently will almost certainly end up with more money than someone who starts at 45 and invests much larger amounts. Starting early matters more than starting big. Alright, so if index funds are so great, why does anyone do anything else? This is a fair question, and it leads us to one of the most telling stories in all of finance. For decades, an entire industry of professional fund managers has existed with one core promise: that their expertise, research, analysis, and market insight can help them pick stocks better than a random list, and therefore, they can earn you better returns than just buying the whole market. These active fund managers charge fees for this service, often quite meaningful fees. And the question is, do they deliver? The data here is genuinely stunning, and not in a flattering way for the professionals. Research tracking the performance of actively managed funds consistently shows that the overwhelming majority of them fail to beat their benchmark index over long time periods. We are talking about close to 9 out of 10 funds underperforming over a 20-year period in categories like large US stocks. Think about that, 9 out of 10. And this is not measuring whether they beat the index by some impressive margin. This is just whether they beat it at all. Some categories look even worse. Even the funds that do outperform in one period frequently fail to maintain that advantage in the next. The fees make this situation even harder to justify. If you pay an active manager and they underperform the index anyway, you have paid extra for worse results. You lose twice. Index funds, by contrast, have extremely low fees because they are not paying for research teams or analysts or stock-picking expertise. The fund simply tracks the list automatically. Those fee savings compound over decades just like your returns do, adding meaningful extra money to your final outcome. And here is the thing that makes the performance gap even harder to explain away. This is not just about retail investors making emotional decisions. We are talking about professional investors with full-time research teams, sophisticated data tools, and decades of experience. If they cannot consistently beat the market, what chance does someone casually watching stocks between work meetings have? The evidence strongly suggests the market is quite efficient at incorporating available information into prices very quickly. Finding a reliable edge is genuinely hard. Now you might be thinking, okay, but what about choosing the right type of index fund? Because they are not all identical. When you start exploring this space, you will encounter options tracking different markets. The S&P 500 focuses on large American companies. Total market funds include smaller companies too, giving you even broader exposure. There are international funds covering companies in Europe, Asia, and emerging economies. There are bond index funds for people wanting lower risk and more stability, which become more relevant as you approach retirement and have less time to recover from market downturns. You will also run into the word ETF, which stands for Exchange Traded Fund. These are very similar to traditional index funds, in that they both give you exposure to a basket of stocks. The main practical difference is that ETFs trade throughout the day like individual stocks, while traditional mutual fund index products typically price once at the end of each trading day. For most regular investors just getting started, this distinction matters very little. Both give you the diversification and low-cost structure that makes index investing so compelling. One question that comes up constantly is whether to invest everything at once or spread it out over time. If you have a lump sum sitting in your bank account, research does generally suggest that investing it all immediately tends to produce better average outcomes than waiting, simply because more time in the market usually beats more perfect timing. But if the thought of putting everything in at once and then watching the market drop immediately makes you feel physically ill, that is actually a real concern worth taking seriously. An investment strategy you abandon because you panicked and sold everything during a downturn is worse than a slower strategy you actually stick with. Dollar cost averaging, which means investing a fixed amount at regular intervals, regardless of what the market is doing, is an excellent approach for most people. Some months you buy when prices are relatively high. Some months you buy when they are lower. It averages out, removes the emotional pressure of trying to time things perfectly, and keeps you consistently building your position. It is also how most people practically invest anyway, since it aligns naturally with getting paid and having money available to contribute each month. Let us talk practically about tax-advantaged accounts, because this piece dramatically accelerates your wealth building, and many people either do not know about it or do not fully use it. In the United States, accounts like a Roth IRA or a 401k allow your investments to grow either tax-free or tax-deferred. In the UK, a stocks and shares ISA does something similar. The basic idea is that normally when your investments make money, the government wants a portion. These special accounts create a protected space where your gains compound without that tax drag eating into them each year. Combining an index fund's naturally low costs with the tax benefits of these accounts is genuinely one of the most powerful legal wealth-building combinations available to ordinary people. Getting started is simpler than you probably imagine. You open a brokerage account through an established provider. For Americans, names like Vanguard, Fidelity, and Charles Schwab are reputable and offer excellent low-cost index fund options. The founder of Vanguard, John Bogle, is widely credited with bringing index fund investing to regular people and creating a model that genuinely prioritized investor outcomes over industry profits. Once your account is open, you search for a broad market index fund, or ETF. Check that the annual expense ratio is very low and invest. Then you set up automatic monthly contributions if you can. Then mostly you leave it alone. That last part is harder than it sounds. Markets go through periods of volatility. Prices drop sometimes significantly. Your portfolio balance will shrink during these moments, and it will feel genuinely uncomfortable. Every instinct will tell you to do something about it. This is where most people make their biggest investing mistake. They sell when prices are low, locking in their losses, then wait to buy back in until the market has already recovered significantly, buying back at a higher price. This pattern destroys returns. The entire strategy of index investing depends on staying invested through the rough patches and letting time do its work. This is also why starting with a level of investment that does not feel terrifying makes sense. If you put in so much money that a 15% drop causes you genuine panic, you might not hold on. Investing an amount where you can acknowledge that downturns happen without catastrophizing makes the emotional side manageable. So let me bring this all together and give you the honest version of what index fund investing actually is. It is not exciting. It is not going to make you rich overnight or give you great stories about that one stock pick that paid off. It is a patient, systematic, evidence-backed approach to participating in economic growth over time with extremely low costs, genuine diversification across hundreds of businesses, and the compounding power of time working relentlessly in your favor. The people promoting complex alternatives often have financial reasons to do so. The people selling you on the idea that you need expertise or expensive management to invest successfully are frequently the ones charging for that expertise and management. The beautiful irony at the heart of all of this is that the investment strategy designed for people who hate investing and do not want to think about it constantly actually tends to outperform the approaches taken by people who obsess over it daily. Doing less, in this case, really is doing more. Open the account, pick a broad, low-cost index fund. Set up automatic contributions at whatever level you can genuinely sustain. Stop checking it every day. Let compound growth work on it for years and decades. That is the whole system. You now know more about building wealth than most people ever learn. The only question left is whether you will actually do something with it.